Yeah. And good evening to each and everyone who are present here. Today, we are going to discuss about moving averages. Yeah. Today, we are going to discuss about moving averages. So, a moving average is one of the most basic tools in technical analysis. It helps us smooth out price data over a specific period, making it easier to spot trends in the market. Instead of focusing on the daily ups and downs, a moving average provides a clearer view of the overall direction of a stock. So, moving averages are a fundamental tool in technical analysis, and they come in various types like simple moving average, exponential moving average, weighted moving average, daily moving average. Like in trading view, you can take any stock, you can take any stock, any option, any indices as you wish. And on indicator, you can search for moving average. So when I search for moving average, MA, here you can see it is an exponential moving average. It is a simple moving average. It is a weighted moving average. So what is the difference between this exponential, simple, and weighted? We will know more about it further. So on indicators in any, in any app like TradingView or Webull or any bar chart or any other, if you go to indicators and search on moving average like MA, here I had searched MA, which is moving average. I got options like exponential moving average, simple moving average, weighted moving average. So here the problem is, as some of you may know, that in trading view, you can use only two indicators at a time. You can't use more than two indicators. If you want to use more than two indicators, you have to take the premium subscription. So due to that, I am now using the bar chart. So in this bar chart, there is no restriction for indicator. Yeah. So in bar chart, there is no restriction for any indicator. So here, uh, there are different kind of moving averages, like simple moving average, exponential moving average, weighted moving average, daily moving average. So first of all, what is a moving average? A moving average is simply the average of a particular set of values over a specific period. For example, for example, if I apply a 21 period moving average, like here, like I will cancel all this, like here, yeah. If I go to indicator and if I apply, like here, I will take simple moving average. Moving average, if I apply, for example, let's say 21 moving average, it indicates for example, if I am applying a 21 period moving average, it calculates the average price over the last 20 candles. Like here, in the last 20 candles, it calculates the average price of the last 20 candles. Like on different time frames. Like if I apply it on 1 hour time frame, I will get the average price over the last 20 hours. Similarly, if I apply it on a 15-minute time frame, I will get the last 20 period moving average, which is 300 minutes, like last 20 candles in the sense 300 minutes. But here we need to observe that the price won't stop in one place. Like for example, here the chart, here, okay, till here the candle is there. So if the market opens tomorrow, the new candles will form. The new candles will start form. Okay, here, okay, till here I am telling that if I am applying 21 moving average, it means that the last 21 candles, it is the average of last 21 candles. But tomorrow, if market opens, so new candles will start forms. Then what will happen? The average will move according to the price. So the price won't stop in one place. Since prices are consistently changing, the average also shift the average also shifts accordingly, which is why it is called a moving average. So how does this moving average help you? So for example, consider an analogy. Like for example, consider an example. Like if I ask you, what is your average sleep time is? And you say it's around 6 to 7 hours per day. So then I might predict that if you have been awake for 15 to 16 hours, you will probably go to sleep soon. In reality, you may or may not. But the average helps in making a reasonable assumption. Similarly, when you wake up, I will assume like for the next 15 hours you will not sleep. Similarly, in trading, by looking at the moving average of past prices, it helps in predicting potential future price movements. However, like sleep, nothing is guaranteed. Like uh, for example, if you wake up for 15 hours, I think you all have been wake up from the morning. So I will assume like in the next 2 to 3 hours, all people are going to sleep. It may or may not. Sometimes if you have some any important work or any other issue, you may not sleep. But I will make an assumption like, okay, you have been awake till from the morning till now. So there is a high chance that you may now go to sleep. So in the similar way, moving averages also helps us to make an assumption. So uh, there are many indicators in the market. So like previously I had told, like there are many types of moving averages, like simple moving average, exponential moving average, and daily moving average, weighted moving average. So out of these all moving averages, two moving averages are very, very important and they are very widely used in stock market. What are these? Simple moving average and exponential moving average. So there are many indicators in the market, but it's more practical to focus on the most popular and widely used ones. What are these? The simply moving average and the exponential moving average. So here, if you call moving average, or if you call simple moving average, or if you call daily moving average, the same meaning will come. Like I mean, if here we are discussing about simple moving average, it also means that we are discussing about daily moving average and moving average because all of these terms leads to similar concept. So here, the only difference between simple moving average, exponential moving average, weighted moving average. What is the difference between these three? So in simple moving average, so for example, let us see practically. Like here, earlier, this is the stock NVIDIA. Earlier, I had taken a moving average. As you can see, this is a simple moving average. Now I will take an exponential moving average. Like, so I'm taking an exponential moving average, same 21, 21. on 21. Okay, I had taken normal moving, simple moving average on 21 and exponential moving average on 21 and now weighted moving average. Yeah, this is weighted moving average.
Arshad,
Again, the same.
are you saying the 21-day moving average?
Yeah, yeah, yes.
Okay.
Yeah. So, yeah, as you can see, for the NVIDIA stock, I had taken a simple moving average of 21 days and exponential moving average of 21 days and weighted moving average of 21 days. I had taken three moving averages. As we can see, the simple moving average is in the color of something cement and and exponential moving average is in the color of red and weighted moving average is in the color of pink. So here, see, I had taken the same 21. I have not taken any different thing. You can check here. It's the same 21, 21, 21. But still, you can see the difference. There are three different lines. I mean, at the end of the day, moving average is a similar concept. So if you think logic, if you think technically, it has to be on same line. But here you can see that the simple moving average can be seen separately and exponential moving average can be seen separately and weighted moving average can be seen separately. So why is that? Let us know. So the difference between this simple moving average, exponential moving average, and weighted moving average is like if I say if something happened 10 days ago, is it more important? Or if something happened 1 day ago, is it more important? Like obviously, if something happens 10 days ago, it's not that much important. If something happened 1 day ago, that is more important. So here, like in 21 days, in 21 day, as we are calculating the 21-day moving average, obviously what happened previous day will be more important. So when calculating the averages, if you give equal importance to all 21 days, if we give equal importance to all 21 days, then it is the 21 days simple moving average. If you give equal importance to all 21 days, then it is the simple moving average. And if we give more importance to what happened 1 day ago and less importance to what happened 21 days ago, then it is an exponential moving average. And if we give extra more, I mean more and more, very, very extra importance to what happened 1 day ago, and very less importance to what happened 21 days ago, then it is a weighted moving average. I mean, I hope you understood the difference. In simple moving average, we give the equal importance to all the 21 days, equal importance. In exponential moving average, we give somewhat high priority to what happened 1 day ago and very less priority to what happened 21 days ago. In weighted moving average, we will give more and more, very important, very important to what happened in 1 day ago, and very less importance to what happened 21 days ago. Simple. This is the difference between these three. So that's the reason. Even though you apply the same 21-day moving averages, still you are seeing the three different lines here. So So in simple moving average, this type of moving average gives equal weight to all values in the period. For example, a 21-day simple moving average, it averages the price from the past 21 days, treating each day with equal importance. In exponential moving average, unlike the simple moving average, the exponential moving average gives more weight to recent prices, meaning what happened yesterday is more important than what happened 21 days ago. This makes the exponential moving average more responsive to recent price changes. In finally, the weighted moving average is similar to the exponential moving average, but with a different calculation method. It also places more emphasis on recent data. So now, now as you can see, simple moving averages. I hope you had understood the difference between these three. So here, the below line, which is the somewhat like cement color line, it is the simple moving average. And the middle line, which is in the red color, it is the exponential moving average. And the pink color line, which is on the above line, it is the weighted moving average. So as you can, as you can go historically and check, it will be the same. You can see different types of lines. So what does these lines indicates? We will study it further. So, so here, the main question, what we will get was like, which moving average do we need to use? Like there are different types of moving average from last 2 days to 200 days. You can have different type of moving averages like 7 EMA, 9 EMA, 21 EMA, 50 EMA, 100 EMA, 200 EMA. So traders often wonder which moving average to apply. So the answer to this is the choice depends on your trading strategy and perspective. Different traders may use different moving averages based on their analysis, time frame, and objectives. Remember, there is no one size fits all approach. The key is to find what works best for your strategy. So here, for example, I had taken the Dow Jones, and I had applied. As you may know, more importantly, we will use in simple moving average. We will use very less in charts. In charts, we will use more exponential moving averages. So I will take two different. Uh, uh, two different moving averages, exponential moving averages. Like here, I had taken one, like for example, for the understanding, I had taken the 9 exponential moving average, and I will keep this color at green and somewhat thicker, and then 50 moving average. Then I will take this as other moving average as 50 moving average. 50 moving average, and again I will change this color to red. Yeah, I will change this color to red. So here, so here, there are two types to understand this. There are, in this moving averages, there are two concepts. One is fast moving average and other one is slow moving average. Like, uh, it's like fast versus slow. So moving averages are key tools in a technical analysis, and their behavior on a chart can tell us a lot about market trend, support and resistance levels, and potential buy or sell signals. So as you can see, support and the levels in the from here you can see from 31st October 2023. So it is a 9 EMA. As you can see, how many times these Dow Jones had taken this support at 9 EMA. It takes number of times. As you can see, number of times. And you are seeing sometimes it is going below the 9 EMA. So below the 9 EMA, then it means that it is taking support at other EMA. It's not 9 EMA, it's taking support at other EMA. So further, we need to change. This is where the analysis come. Previously, I had told you like there are different types of EMA from 2 EMA to 200 EMA. There are number of EMAs. So which EMA should I use? So here where the analysis come. So here, as you can see, mostly from most of the part, mm, for most of the part, the support is taking at 9 EMA. But you can see sometimes it is like here you can see sometimes it is going below 9 EMA. So why it is going below 9 EMA means here this EMA 9 EMA does not fit right. So here we need to go to settings and we need to check with different EMAs. Like for example, in place of 9, I will type 21 and I will click on OK, for example. Okay, then you can see the EMA had gone further. In place of 21.
Hey, Arshad, when you're sharing your screen, we are just seeing the same screen wherever you are. So we don't know from where you're showing what you're showing because it's just
Yeah,
like,
okay. Yeah, this yeah. Now is it okay?
yeah, we can see it.
Yeah. Yeah, for example, just for understanding, I have taken Nvidia or any other. You can take any other stock. If you are doing, I mean, if you are doing intraday trading, if you are doing scalping, then go for 5 minutes time frame or maximum 15 minutes time frame. So yeah, 5 minutes time frame will be better. But if you are looking for a long term, then obviously look at daily time frame or weekly time frame. So at present I'm keeping this a daily time frame and I'm taking EMS like uh, two different EMS. So one is 9 and the other one is 50. So here, what are the fast moving averages? There are two things. I mean, for every moving average, we can see fast moving average and slow moving average. So what is the fast moving average in the sense? It is the low period. Like here in my example, what is the low period you are seeing? Whether nine is the low period or 50 is the low period. I mean, nine in the sense last 9 days, last 9 days. 50 in the sense last 50 days. So obviously, this nine is the low period. This 50 is the high period. So in fast moving averages, it is stay. I mean, these EMS, these moving averages, like these 7 moving average or 9 moving average or 20 moving average, these EMS, these stay close to the price on the chart because they respond quickly to recent price changes. They are useful for identifying short-term trends. On the other hand, you have slow moving averages. Like in contrast to slow moving averages, like 50 moving average, 100 moving average, 200 moving averages. So these are the more slowly. These move more slowly and tend to be further from the current price. They are better suited for spotting long-term trends. Like you can see here, like 9 moving average, it is responding to the recent price changes very accurately. Whereas in the downside, 50 moving averages, you can see it is, I mean, it tends to be somewhat slow. It doesn't respond much faster to the recent price changes. So that's the difference between these slow moving averages and fast moving averages. So these moving averages help traders to identify key levels of support and resistance as well as to determine the right moments to enter and exit trades. They are particularly useful for confirming the trend direction, which is crucial since the trend is your friend until it bends. Moreover, moving averages can also signal potential trend reversals. Like here, like assume, let us assume like, yeah, for example, yeah, let's see, for example, uh, if I want to take a trade, so see, let's here, let us think like we were in, okay, we were in here 5th July, 5th July 2022, like at this point, okay, we were at this point, let us assume like we were at this point. So I want to take a trade, I want to take a trade. So here, so at this point, if I am at this point, so I want to take a trade. So as you can see here, the trade had taken support. It had taken 9 EMS support. And when it had taken 9 EMS support, I mean, if I consider it as support, and then if let's assume like if I enter into the, I mean, if I purchase NVIDIA share at this price, as you can see from here, it had moved to this place, like from $15, from $15, so it had moved till $19. So again, the similar here. I mean, if I purchase here, by considering it as support, as you can see, it is taking support many times at this time, and similarly, it is taking resistance too. I mean, if you think, if you see below these red candles, these all are taking resistance with the line EMA. So these moving averages can be useful as identifying support and resistance levels, and sometimes by using this moving averages when it had taken support and when it break the resistance, so we can expect for the trend reversal. Like here the trend had been reversed, like here the trend had been reversed because it had taken the resistance, and when the breakout happens, the trend reversal had occurred. So we will know uh, more further, and then yeah, here, the, like for example, I mean widely used, as many people may have listened that for long terms we will use 200 EMA. Like 200 EMS are very famous for the long term, to identify the long term of the stock, and to long term trend. And then as here, I will keep the 50 EMA. So now here, as you can see, as you can see, 50 EMA. Like green candle is the 50 EMA, and yeah, red color, which the line which is in red color, it is the 200 EMA, and the line which is in green color, it is the 50 EMA. So again here, 50 EMA is the fast moving average. Here 200 EMA, it is the slow moving average, because when compared to 200 moving average, 50 moving average will react to the recent prices very quickly. The 200 moving average will react somewhat less. It will not react very quickly. So here, in 200-day moving average is often recorded as a maximum, like it is uh, I mean, we record it as a very important, many analysts, many people will consider this 200 moving average is as a very important tool. So data or trends, anything above it might be less significant. Means the maximum moving average you can use is 200 moving average. So like if you want to use 210 moving average, 250 moving average, like more than 200 moving average, it is completely waste. So the maximum which can give you good result is the 200 moving average. So, so there is a myth, like there is sometimes there is a myth like this particular moving average is important. So there is a myth like big players often make their moves around this particular EMA, while historically this may be important, but it's unrealistic to assume that institutional investors or market makers strictly wait for the particular EMA before making decisions. Like, like in the sense, some people will tell like this particular EMA will work better. This is the place where big players do buy and sell. Like for example, here I will show you like yeah, as you can see here, as you can see here at this place, this moving average, here it had taken the support at 50 moving average, and at the same time it had taken support and 200 moving average. So if you consider this, and if you get into trade, then you will be so profitable. Like here you are getting in the trade at some $17, around $17. But from here you can see, I mean, if you consider this trade, like, okay, it had taken support at both these levels. So if you consider this, and now it had gone till from $17 to around $40. So that's a very huge amount. So here the myth is like, some people will tell like this particular EMA will work better. Like 200 EMA is the best, 50 EMA is the best, 9 EMA is the best, or any other particular EMA is the best. It will work better. This is the place where big players do buy and sell. So, do you think that the change in time, do big players exactly wait for that particular EMA for buy or sell decisions? Like, let's assume that if there is any big institution like NVIDIA or anything, a very big institution or any HMI or any other person, do they wait like, okay, I will wait for the 9 EMA, I will wait for the 50 EMA, I will wait for the 200 EMA, and only when this 200 EMA comes, then only I will make my buy or sell decision. So obviously they will not wait like that, right? So I mean, do they think like I had read somewhere in the book or listened somewhere that this EMA is important? So let us wait till the EMA comes and then make our buy and sell decisions. A market operator or market maker is not going to wait for you to create that sort of particular moving average. You need to apply your permutations and combinations according to your strategy. So by moving averages, we can definitely assume buy signal and sell signal. So by using this moving averages, there is it works. It works many times. It works many times. By using this moving averages, we can assume buy signals and sell signals, and we can also call it as golden crossover strategy and death crossover strategy. So what is this golden crossover strategy and death crossover strategy? So when a fast moving average, here again, it is very important to understand these two things. So what is the fast moving average? Like the less period, the average which has a less period, it is the fast moving average. And the average which has a fast period, it is a slow moving average. Like in our example, 50 EMA is the fast moving average and 200 EMA is the slow moving average. So when we will get a buy signal, when we will get a buy signal means when a fast moving average, that is 50 EMA, crosses above a slow moving average, that is a 200 EMA, from below, it indicates a potential buy signal. Like here, from historically, you can see, from any time, from historically, you can see. So this green candle is a fast moving average. This fast moving average is crossover. This moving average crosses a slow moving average from below. From below. So if a fast moving average is crossovering a slow moving average from below, then it is known as then it is known as golden crossover strategy, and it indicates a buy signal. As you can see historically, you can see at this point, like at 1 February, uh, at this point, like at 1 February, you can see here uh, the fast moving average crossovers the slow moving average from below. So it indicated a buy signal. When it indicated a buy signal, you can see from this $17, it had went, and again it had went till stop $123. So when and now still now it is still going, because there is another thing called death crossover strategy. What we will study further, and historically we can see another time too. Yeah, here other time on September 19, on the year 2019, on the year 2019, it again the fast moving average crossovers the slow moving average from below. It is a buy signal. As you can see, as here I got a buy signal approximately for the next 2 years. Approximately for next 2 years, I had got this buy signal completely. I had made a profit. Again, you can see historically. I mean, we can see for other charts too. So, uh, yeah, as you can see again, yeah, again here on the year 2013, on the year 2013 again, this slow, fast-moving average had crossed over the slow-moving average. It had given us a buy signal. So it is a golden crossover strategy. We call it as a golden crossover strategy. What is the golden crossover strategy? If the fast-moving average crosses above a slow-moving average from below, it indicates a potential buy signal. So in the similar way, when do I get a sell signal? When a fast moving average crosses below a slow moving average from above, it suggests a sell signal. Like here, for example, you can see the fast moving average. This is the fast moving average. It had crosses the slow moving average from above. So here I got a sell signal. As you can see, I had got exited from $6. I had got a sell signal. But after the sell signal got, it had fell till $3. So again, you can see, again here I got a golden crossover, and again here the fast moving average is crossovering the slow moving average from above. So it is a again sell signal. As you can see, when I got a sell signal, the share price had fell down so much. So again, when I got a buy signal, the share price had risen so much. So it is a so for short-term trading or scalping, you might use combinations like 9 EMA, 20 EMA. For long-term strategies, so you can use 50 EMA, 200 EMAs. So it is the golden crossover and death crossover. So for example, let me check like for other stock, like some other stock. For example, Intel Corporation. I'm checking for the Intel Corporation. Uh, yeah, again, you can check here. So here I got this fast moving average had crossed over the slow moving average. So here I got a buy signal. So here see when I got a buy signal at $53, around $52.5, I got a buy signal. So if I entered the trade at this time and this share price had risen up to till $70. So here at this point, I got a sell signal. Again, at this point, from where the fast moving average cross over the uh, slow moving average from above. Here I got a sell signal. I got a sell signal at $57, and then the share price had fell down till it $25. As you can imagine, it had given me a signal at $57. By using this signal, I can exit from this trade. And from after the signal, it had fell till $25. And again, it had given me a signal, buy signal at when $31. As you can see, this is called as golden crossover strategy and death crossover strategy. Recently, I checked this to Pfizer. This Pfizer company, it is near the golden crossover strategy. Like as you can see, this here I got. See here, I got cell signal. I got cell signal because it is crossovering from above. So here I got again cell signal. It crossovering from above. at which time it happened? It had happened on January 2023. From this time, you can see it is completely trading below. And it is near now. Okay, as you can see, sometimes from last 2 3 days, the performance was bad. So it is now it is going some far away. But you can keep the stock on the watch list because here you can see approximately from the last 1 month of year, it had traded below this moving average, and now it is getting ready to cross over. So we can keep it on a watch list. So if this, it is a live example I am showing you. You can keep this on a watch list after some period of time. If you can see this 50 EMA, if this 50 EMA cross over this 200 EMA, like we see on previously on other examples, like here it happened in the history, like here it happens. If it cross overs, and if you, I mean, obviously, we solely don't rely on moving averages. We have to check on other indicators. We have to check other things too. But it's giving a very high confidence in purchasing this stock. So if it crossovers in the near future, definitely there is high chance that we can see a very price moment, very huge price moment. Why I'm telling? Because from the last 1 month of year, it is trading below this. It is trading below. So if the fundamentals of this company P Pfizer is looking good, and if you are confident with the fundamentals, and if it crossovers, you can simply close your eyes and you can purchase the stock because there is very high chance that it will go above. So again, I mean, if crossovers at present the crossover had not happened, so it is an example. So so I hope you had understood. So how to use these moving averages more effectively? So first we have to set the appropriate EMA. Like for some stocks, okay, for this Pfizer company, this stock had worked 50 EMA, 200 EMA. Like for some stock, this EMA may not work. For some stocks, you need to apply instead of 50, 40 EMA. Instead of like for example, I'm telling instead of 50, you need to apply 40 EMA, or you need to apply some 25 EMA, 35 EMA. It needs to, you have to do analysis. You have to do that. So how do I know? Like you can see, for example, if I apply 20 EMA, okay, 20 EMA looks somewhat better. See, as you can see previously there is a 50 EMA. Previously there is a 50 EMA, and you can see the difference. See, is it taking the resistance at, I mean, here it is not taking resistance nearest to this level. As you can see, is it taking, it's taking resistance at very few points. It's not taking resistance at very more points. So it is not a correct EMA for this chart. So instead of 50 EMA, if I change this 50 EMA to 20 EMA, 20 EMA, you can see the difference. You can see the difference. It's taking, when compared to above, I mean, when compared to before, it is taking now more supports, more levels. Like if I change this to 9 EMA, it will be more effective. 9 EMA or 10 EMA, if I change this to 9 EMA, as you can see, now you can see the difference completely. Now it is taking support and resistance at every point, almost every point. So by looking at this, I can tell like, okay, for this chart, 9 EMA is more suitable than 50 EMA. So as you can see, right? So again, I mean here the golden crossover may not work because the 9 EMA is very low, 200 EMA is very high, and again, as you can see here, I got the buy signal according to the previous, which I had told golden crossover strategy. Here I got in the buy signal, but still it had not raised further. Why? As I had told you further earlier, like these fast moving averages, they will react to the recent price very quickly. I mean, these fast moving averages, this will react to the recent price changes very quickly. Whereas the slow moving averages, they will react to this recent price changes somewhat slow. So that's the reason. So as you can see, you need to understand which EMA is better for your chart. You need to make the analysis. Like here, I had again changed it to 50 EMA, 200 EMA. So to use moving averages effectively, you have to set the appropriate EMA. Like for short-term trades, use a 9 EMA, 21 EMA. For long-term trades, consider the 50 EMA, 100 EMA, or 200 EMA. And you have to check chart position. Like yeah, if the price is trading above this EMA, like if the price is trading above this EMA at any point, from this point to this point, from any point, you can consider the all this as a buy signal. I mean, you can go here for buy, or at this point for buy, at this point for buy. I mean, it all indicates a buy signals. So similarly, if the price is trading below the EMA, like here you can see it is trading below the EMA. So when it is trading below the EMA, it indicates a sell signal. So it indicates a sell signal. It indicates a bearish momentum. So uh, so here it is only from the technical analysis perspective. There are two things: fundamental analysis and technical analysis. Both things are different. So here we are talking only from the technical analysis perspective. So, like for example, Sairam sir, he had believed in Son company. If you check the charts of Son, it's look very bearish till yesterday. It looked very bearish. So as you can see, it's very bearish. It completely given a sell signal. It had given a death crossover strategy as we discussed, but still he believes in that company because Sairam, he did not check the technical analysis. He believed in the fundamental analysis. So technical analysis is different. Fundamental analysis is the different. So it is important to
Arshad,
note. Yeah.
Arshad, I have a question. Like, if the basic question, I'm sure others might also have is like, you have this crossover coming in, and then it goes to a certain extent, and we see that the gap between the green and red line is increasing, right? I'm talking from short-term perspective, right? The question I have is, at what point I sell and take the profits, because it could be a false indicator. It shows that it's
Yeah.
going down. I sell it, but suddenly it might go up again. So what is that we should take care, or what is that we should consider to decide whether this is the right point to sell or keep
Hello,
moving?
can you ask question after this section, end of the section, please?
Yeah.
Sure.
I mean, yeah. Thank you. Thank you, sir. Like, no problem. We'll talk about that. Like here, the price reversion will happen to the average prices. Like for example, at starting of this meeting, I had given you an example. Like if I assume like now the time is some nearly 9 p.m. So I will assume like in the next 2 hours you are going to sleep. I will assume because you wake up from the morning. So I may wrong this time. I may wrong today. Today I will assume you will go to sleep after 2 hours. You will not go to sleep. You will wake up till 2 a.m., 3 a.m. today. Tomorrow again I will assume that you will go to sleep at 11 p.m. Again I may be wrong. I will assume for 1 week continuously. I will assume for 1 month continuously. I may be wrong for a short period of time. But again and again, after some period, definitely I will be right on one day. I mean, definitely you will go to sleep on night. I mean, today you may wake up today night, you may wake up tomorrow night, you may wake up till 1 week, but definitely after some period of time you have to sleep because in the similar way, what average value indicates in the sense, see here, the price movements are going very far from the averages. For how many days it will go? It may go today, it may go till 1 week, it may go till 1 month. Maximum, I'm telling, 1 month is too big, but still it will go for one day, 2 days, 3 days, 5 days. But after some period of time, definitely the price have to come near its average. Like here, you can see the price had gone above the average. So again, but after some period of time, it had came to its average because it is the standard, it is the natural thing. It have to happen. The price have to come to its average. So here, uh, so here, yeah. So here, as per your question, so here taking trade only basis of one indicator is a foolish thing to be average. Like we need to think many points. We need to consider many points. We don't need to only strict ourselves to one thing. So on a crossover, so here, so like for example, if I want to purchase, like for here, I am at 31st January, this is the point. If I want to purchase here, like here you can see, uh, like here you can see the crossover happened. Like here you can see at this point, uh, June 2023, the crossover happened once. So if I want to purchase at this point, so on a crossover, first we have to wait for the confirmation, whether it is a trap, whether it is a false, or whether it is a true. We have to wait for the confirmation. So how we can wait for the confirmation in the sense? So here, when the crossover happens, one green candle came. One green candle came. So it doesn't indicate the confirmation. When the confirmation comes means then the high of this green candle breaken on the other day, then we can get a confirmation. Like here you can see I got the green candle on 15th June 2023. I had got the crossover and I had got the green candle. But if I just purchase based on this green candle, it may be a false, it may be a trap. So when this confirmation happen is on the other day, when the highest level of this green candle breaks, then I will get a confirmation. After getting this confirmation, if I purchase at this point in the sense 16th June 2023, if I purchase at this point, then from this, from this $3 to it had went to the high of $5. So obviously I got a profit of $1.5 here. So here we have to wait for the second candle to break the high of the first candle before entering the trade. And we have to set our stop loss at the low of the first candle. And here I am entering in the trade at this point. I have to keep my stop loss at the low of this first candle. And we have to use a trailing stop loss further to manage risk. So here, the most important point to note that if you are investing in a company by believing its fundamental analysis, it's a complete different concept. Here we are talking only technical analysis. So it's crucial not to rely solely on moving averages for buy or sell signals. Doing so can result in late entries and exits, leading to potential losses. To increase the accuracy of your trades, combine moving averages with other indicators like RSI, relative strength index, or BWAP, like volume weighted average price. Uh, like here, for example, I'm considering is okay. Like I'm taking this 200 mA. I'm considering. Here it had taken a support and here it had risen. So here it technically it is giving me a buy signal. So I don't have to rely on this blindly. So I need to use other indicators too, like RSI. For example, relative strength index. So you can see here I am getting a here I am getting a buy signal. So at this time, okay, the RSI is around 60. So again, some people may know what RSI means. If the RSI is above 70, it indicates an overbought condition. If the RSI is below 30, it indicates a oversold condition. So here, so it you can see the RSI is at 60. So okay, it is very good momentum. I can see the good momentum. Okay, it is indicating a buy signal for me, and it is indicating also the RSI looks good. Or you can check some other indicator like VW weighted volume weighted moving averages. Yeah, volume weighted moving average price. You can indicate this like or simply MSCD, moving averages, convergence, divergence. It is a very good indicator. like here, you can see where, see, here I got a bisignal. So here I'm checking, I'm looking for a bisignal, and you can see here. So what happened is, if the line is above here, there is middle one line, right? We can call this line as zero line. And if the lines you can see above this zero line, it indicates bullish signal. If the lines is below this zero line, it indicates a bearish signal. And you can see here I am getting a bisignal, and similarly you can see this moving MACD also indicates a bullish view. Sometimes it may happen. Like, see, for example, here also a very big candle break happened. So very good. Here also, technically, here I'm getting a buy signal. So let's assume like all the other candles were not there. Let's assume like today was the 31st March 2023, and I saw, okay, this had broken the momentum. It's very great. And next day again, I had discussed the previous point, right? So see, on 31st March 2023. The green candle came, it crossovers the EMA, and from the and on the next day, the other candle came, and this other candle had a break in the high of the first candle. So obviously, it is giving a buy signal. Previously, I had told no. The second candle had broken the high of the first candle. So obviously, I'm getting a buy signal here. Let's assume today is the March 3rd April. I don't know what will happen tomorrow. So if I just enter into trade based on this analysis, but just by looking at the moving averages, obviously I'm going to make loss, because you can see next day that the chart went so down. So if I combine on this day, if I combine this with this MACD, if I check the MACD along with the moving averages, so in the moving average, the second candle had broken the first candle high, and it is giving me a buy signal. But here on the below, the moving average is not giving me a buy signal. As we can see here, the both lines are below the zero line, which means it is still in a bearish signal. It is not giving me a bullish signal. When I got the bullish signal, I got the bullish signal. I got around after, yeah, 12th April. As you can see, I got the bullish signal on 12th April. Till 11th April, here there is a bearish signal. So here, so just focusing on one indicator, so it's not appropriate to take decisions like that. So in conclusion, while moving averages are powerful tools, they should be used in conjunction with other indicators and within the context of your broader trading strategy. Flexibility and the comprehensive approach are key to successful trading. Moving averages are essential tools for traders of all levels. They help simplify price data and reveal the underlying trends, making them invaluable in the decision-making process. As you grow in your trading journey, you will know how to effectively use these moving averages alongside other indicators to build a well-rounded strategy. Yeah, that's it. Please ask if anyone has any questions.
Thank you, Arshad, for explaining that strategy combining with the other indicators. Yeah, I do use moving average along with RS and MACD. There's another indicator in TradingView. If anybody interested, they can look at AI, like engulfing candle. If you type AI, it will pop up as AI engulfing candle. So that also shows buy and sell indicators.
Yeah, thank you, sir.
Thank you.
Yeah.
I had a quick question.
Yeah. Sir, any other questions?
Awesome job, Arshad.
Thank you.
Yeah, thank you, Arshad. Can you just tell one more time about the golden cross and the dead cross?